I'm here in the Englewood Cliffs headquarters studios with Robert Kaplan, the president of the Dallas Federal Reserve Bank. Mr. Kaplan, President Kaplan, let's start off with the outlook for growth.
Yeah.
I want to talk about it short term and then sort of longer term.
Yeah.
Our CNBC rapid update running at 1.5% for the fourth quarter. That's the median of tracking forecasts. Does this seem like the low to you in the growth slowdown? Is it up from here?
Yeah, we think the fourth quarter is going to be weak, we at the Dallas Fed, and we think that we've got a good chance to grow at 2% next year. One of the reasons the fourth quarter is going to be weak, we believe, is probably a significant inventory adjustment, which might be as much as 0.5% or more of GDP growth.
Where does that come from, that inventory adjustment? Why does
this means people have been destocking, and probably the reason they were destocking is there was a lot of pessimism over the last number of months about, future growth prospects. So businesses destocked. We'll see that show up in the fourth quarter, but we think things will stabilize. We've got a good chance to grow at 2% next year.
So let's go to the long-term part of it. Is 2% the run rate? We can't get out of it. We're not going to go below it. We can't really get above it because a lot of folks wanted us to grow. Everybody wants us to grow.
I agree. And I'd like to grow more. And here's the issue. We've got some structural issues that are not going away. Aging demographics, aging workforce, which means slowing workforce growth. And our productivity's been sluggish, mainly, we think, at the Dallas Fed because of lack of investment in skills training and education, and also this sluggish capex that we're seeing, probably due primarily to deglobalization, is also reducing productivity. And so GDP growth is made up of growth in the workforce and growth in productivity. So we think at the Dallas Fed, potential GDP growth in the United States is 1.75% to 2%, but it gets worse. If we don't make some policy changes, we think over the next 5 or 10 years, it's going to slowly decline.
Be even less than that.
It will, yes.
But what if we were, for example, to stop this deglobalization, which I think is a euphemism for the trade war?
It's a euphemism.
Maybe the trade war is a euphemism for deglobalization. Anyway, isn't that somehow subtracting from growth right now?
Yeah, I think weak manufacturing, weak global growth, weak business investment all relate to uncertainty regarding trade. And if that got stabilized, I think we'd have a chance to see those measures improve.
How fast could the economy grow if we put the trade war behind us?
I'm still of the view, and we're of the view, potential in the U.S. is around 2%. And for people who are disappointed in that, I'm disappointed in that. And we should be, because we're very highly leveraged as a country, particularly at the government level. But if you want to grow faster, we need policies away from monetary policy. Monetary policy is not going to address this. You need infrastructure spending. You need immigration reform. You need policies that improve education, skills training.
Let's talk about monetary policy. Is the mid-cycle adjustment over?
For me, yes, it is. For the time being, I think policy is in the right place right now.
And how do you come to that conclusion?
It was my view back in June that we needed some adjustment, and one of the tells of that for me was the shape of the yield curve. And a lot of people say, the yield curve doesn't mean what it used to. I don't actually agree with that. I think when you have the Fed funds rate above every rate along the curve, it was a signal to me it has to be adjusted. We now have a more normally shaped yield curve. And that, to me, is reinforcing the fact that I think 1.5 to 1.75 on the Fed funds rate is now about right. And I'd need to see some material change in the outlook to cause me to want to adjust that rate.
Let's talk about the risks. The Fed was raising rates in 2018.
Yeah.
And then it cut them.
Yeah.
Sort of 2 steps forward, 1 step backward, or 1 step forward, 2 steps backwards. Yeah. In any event, is it okay to run the economy at a funds rate of 1.5 to 1.75? Are there risks that are being created, for example, in debt?
Well, yeah. I mean, when we run interest rates that are historically this low, you tend to create excesses and imbalances. And that's a nice way of saying financial market, stock market PEs get higher, cap rates on real estate get lower, and you worry about consumers leveraging up and buying more goods and services with leverage. And so I'm watching all that. But on the other hand, we have to accept if potential growth is 1.75 to 2, Fed funds rate's going to be historically lower than we're accustomed. And we're seeing look at the 10-year Treasury, Over the last year, it went from 3.25 to 1 3/4. I think the markets are telling us that if prospects for growth are this sluggish, you're just going to have lower rates than we've had historically.
So this is one of the cool things about Squawk Box. We got Leader Cantor on the desk at NASDAQ. He's going to ask President Kaplan a question. Go for it, Eric.
President, it's good to see you.
Good to see you too, Eric.
This morning. There's been a lot of coverage lately on the increasing indebtedness on the part of corporate America.
Yeah.
There's been some scrutiny on the CLO markets. And just wanted to understand what you think systemically that poses, whether there is some risk. I mean, there's folks out there who've analogized to '08 and the RMBS market. And how do you think all that fits into what you've been talking about in a slow growth environment and the potential for rates to either go up or what happens if they do with all this indebtedness?
So to your point, we've got a record level of corporate debt. And to be specific, BBB debt has tripled over the last 10 years. Leverage loans as well as BB and single B debt has grown dramatically. It's not like '08, '09 because in that the problem with '08, '09 is the lenders were over leveraged. Right now we have an issue where the borrowers are highly leveraged. And my concern is if you have a downturn where we grow more slowly, it means that this amount of debt could be an amplifier. And what I mean by amplifier, a higher percentage of cash flows are being spent on servicing debt. I don't think the CLO market will be the place the problem occurs because I think the CLO structure, and for your viewers, that was the tranching of bank loans. That actually fared pretty well in '08, '09, and I've taken a hard look at it. I think it'll fare reasonably well in the future. The thing I am worried about is if you get 2 or 3 BBB credit downgrades to BB or single B, that could lead to a rapid widening in credit spreads, which could then lead to a rapid tightening in financial conditions. We're more vulnerable to that now with this amount of corporate debt.
We need to just provide the background. You spent a little bit of time at Goldman Sachs, so this sort of area is not something you're unfamiliar with.
So 23 years, yeah.
Let me go to this issue here of worker shortages. And you have a sort of different idea about the capital spending decline. And you've heard from some of your folks in the Dallas district, which is not a small district, that one reason companies aren't investing is they can't find the workers for it?
So it's probably the secondary reason. So the first reason I hear, not only in Texas but nationwide, is uncertainty, policy uncertainty generally. And it's not just the trade dispute with China. It's trade uncertainties globally. The threat against Mexico that happened 2.5 months ago, even though it didn't occur. Logistics and supply chain arrangements. Auto tariffs being threatened against Europe. It creates enough uncertainty that most businesses I talked to have said, we're just going to put CapEx on hold. Now, a second reason, which you mentioned, I hear from people, is they can't find workers, they can't find engineers, they can't find service-oriented workers. And when I ask them, what are you doing about it? They're just saying, we're just delaying CapEx and we're slowing CapEx because we're not sure we can staff some of these projects. So I think it's a secondary reason, but I think it's worth noting we are very tight in the labor force. We're getting underrepresented groups in. I hope that continues. But we should recognize we've got a historically tight labor force.
Robert Kaplan, Dallas Fed President, thank you for joining us this morning.